Welcome back, investor. We got another episode of Passive Income Adventures today. We've got Cole Oliver from King Operating. It's an oil and gas investing company. And I wanted to go down this oil and gas rabbit hole for quite a while because I don't know if you remember, maybe a couple of months ago, we had a financial planner on the show and we were talking about different kinds of tax breaks that our particular investors could get. Accredited investors, high income, usually W 2, who are looking for passive income so that they can retire from the W 2 early to either retire, or to start a business, that kind of thing. And I was talking about how I'm a real estate professional and I basically get so much depreciation to offset my active income. Our adjusted gross income is like zero every year. And I just didn't really feel like I needed any other tax breaks. That's a pretty powerful one. And I was asking him about what W 2 workers could do, especially when both of them are W 2 and neither one can become a real estate professional. And he mentioned the short term rentals, which most of my investors, when I tell them about it, have rejected it, because the reason that short term rental can offset your active income is because it's an active business that you can then use those losses in a business. It's not depreciation anymore. It's actually business expenses. And people are like, oh, I don't want to start a business. And I've had lots of my investors tell me that they're not interested in going down the short term rental. So I said, is there anything else that these W 2 workers can do that can offset their active income using passive losses? And he just kind of shrugged and he said, oil and gas. And so that kind of got my mind spinning, thinking like, I don't know anything about this. But for my investors and for my listeners, I feel like this is a really important question, because not my investors are not listening for passive real estate income so they can go start a real estate business like I did. And so today we've got Cole Oliver on to just go over this whole industry, the different kinds of assets we have, the pros and cons of each, because you're going to have some that are higher risk, higher reward, some that are more consistent and stable cash flow, and everybody's going to have different goals. Are you trying to save your money on your taxes, or are you nearing or in retirement where you're looking for more stable cash flow? Just like in real estate, it's going to have different classes and different types of projects that are going to have different pros and cons. And so this show is really about due diligence. If you're going to be passively investing in somebody else's business, then you really need to learn the questions to ask, the kind of business you want to invest with. So this is kicking off kind of a informal series of talking to different oil and gas operators so that we can figure out our way through this path together. Because even if you are investing with us directly through Retoro for real estate, we do one very specific kind of real estate investing, and you may need to diversify into other parts of real estate and diversify into completely non-correlated asset classes to oil and gas. So with that said, we are going to buckle up our ignorant selves into the seat, and we're going to welcome Cole on so that he can start to educate us about how we get started with oil and gas. So thank you so much, Cole, for joining us on the show today.
Absolutely. Thank you for having me.
Tell us a little bit first about yourself, how you got involved in King Operating, and then we can kind of jump back in and start to look at the industry as a whole.
Totally. Growing up, my dad and my grandfather were both in oil and gas. They worked in a variety of the engineering, operations, and eventually management side of that business. And so I've always been very finance focused. I studied economics in college. And so I don't know anything about the drilling side of the equation, but I know a lot about the cyclical nature of the commodity itself, natural gas, oil. If you Google the prices, you don't even know what you're looking at half the time, because you have crude, you have WTI, you have Brent, you have a variety of different things. A lot of people even ask me like, hey, if it's 250 at the pump, does that mean a barrel of oil is like $2.50, or what does that mean? So there's a lot of confusion that goes into just actually figuring out, is oil doing well right now from a commodity standpoint? Is it doing poorly? But as I kind of began my career, I worked in a couple of high growth tech startups. I started a company myself, and ultimately the opportunity at King basically just fell in my lap one day. And it was this weird kind of marriage of what my dad had done, what I had been focusing on the capital raising side of the world. And so it was an opportunity that I wanted to explore. And 3.5 years later, we're still there. So it's been a fun journey for sure, and getting to meet tons of people like yourselves in real estate as well, and learning a lot more about the larger passive income and alternative investment asset class.
Yeah, I know. So you said you were raising capital before you started with King. What was
Yeah,
your asset class before?
that was high risk, high growth tech startups. So
Okay.
that was either raising for my own venture or helping a new company kind of take off.
Okay, perfect. Yeah, so when I attend angel clubs, angel investing clubs, they don't wanna look at real estate and they don't wanna look at oil and gas because they're like, "We already
Nope.
have lots of that. How do you think we made all our money in the first place?" I often joke every time I go to an angel, I'm like, "Why am I here?" Because they're looking for those bigger reward venture capital, but I think that there's a certain place of foundational type of income that you have or wealth and cash flow so you can pay your bills before it makes sense to start jumping into some of these higher risk, higher return, um, opportunities. And so, so you studied economics in college. You were doing venture capital raising, and then because of your oil and gas background, you got the opportunity at King. So, can you explain to us what King does in the context of the larger oil and gas space? So, where do you specialize, and what are the other categories that other companies might be able to specialize in?
Totally. The most common and what has largely been done over the last 50, 100 years in terms of private investing in oil and gas is a single well bore assignment, unless you're like directly investing in a company, which would basically be like VC of oil and gas, just helping someone get started as a new operator or something like that. But a single well bore assignment is what most people would think of when they think of oil and gas investments. That's where a company says, hey, we're selling 10 units of this one well. It's going to cost us $5 million to drill it. And you're going to have your pro rata share after splits of whatever that well produces in
Mhm.
perpetuity until it runs dry. The risk profile of that specific investment, in my estimation, is extremely high unless it's something where you're buying into a field that's already produced and you're buying into the 10th well. You're paying a premium for that. The return profile is going to be very, very slim because so much of the risk is already off the table and you're
Mhm.
paying for that de-risk. But those investments typically are more exploratory. The company, the operator is going to lease the entire field. They're going to have a plan to drill probably 10 to 20 wells, and they're going to sell each of those as an individual well bore assignment. You
Okay.
have no long term upside. You are isolated to that one well or small group of wells that you've invested in.
And so that's kind of like the dreaded dry well syndrome that people talk about.
Totally, or even just that it's significantly underperforming in relation to the pro forma or the expectations that the operator and geologist had.
So high risk, high reward, but great tax loss potential.
Guaranteed tax benefit, and that should be the case for any type of oil and gas investment, unless you're buying a royalty or mineral right. That
Mhm.
does not have the active tax advantage that we're going to dive into a little bit later. But the high risk, high reward, I would say there is the chance of it being extremely high reward, but it's more than likely just going to be something that pays out over a very long period of time because that well is going to just produce for however long it lasts. So it's mailbox money. It's a little bit more conservative than some of your like Beverly Hillbillies style oil and gas plays where you're just trying to like hit a gold mine.
So
And
exploratory versus, I guess, can you break these into categories for me? So you've got like
yeah,
exploration versus proven, maybe unproven well, but proven field. Like, how do you categorize? Like, I have multifamily, I have industrial, I have,
yeah,
residential. How do you categorize these oil and gas opportunities?
the real estate example or comparison is like if you were in Dallas and you wanted to go into Highland Park, one of the most expensive areas, and build a house. There are so many good comps in the area. You know what price per square foot you're going to be able to pull on that building or development or apartment complex or whatever type of real estate asset it is. Versus if you were to go into South Dallas and it's an extremely rough area and you're just basically rolling the dice that this is going to be an area that experiences gentrification over the next 5, 10 years, and you're going to catch that moonshot of $100 a square foot today to $1,000 a square foot in 5 years. That type of risk is more in line with um, exploratory or just kind of throwing a dart at a random field or a random family farm in Texas. And because it's in Texas, you assume there's oil and gas there. But realistically, there's no nearby wells, there's no nearby producers. Shell, Exxon, Devon, none of those guys are anywhere within a 100-mile radius. And it's just all guesswork at that point. You don't have geology, you don't have anything. Now, what you were talking about a moment ago is more in line with developmental drilling.
Right.
That's where you're going into a proven basin or field like the Permian Basin, which most of us have heard of at some point, just because it's one of the most prolific in the world, if not the most. And that is going to be more expensive lease. Again, you're kind of paying for a premium asset or premium real estate. Oil and gas companies don't buy the fields. They just acquire leases that are held in perpetuity as long as they're either drilling or producing. And then you're paying a mineral right or a royalty to the landowner.
Okay. All right. So I also heard there was one time several years ago when we were first starting to learn about this as an asset class. Somebody was saying that we could 1031 from a real estate deal into an oil and gas deal because this particular company, I don't even remember which one it was purchasing the land versus leasing the land. Is that another type of business model? Do you know? I know that's not exactly what you do, but just as in the sense of giving us an overall landscape of things we could be investing in. Is that something that is common, uncommon?
Extremely rare.
Okay.
It's so much more capital intensive to buy the land
Mhm.
that, number one, a lot of the time, the best fields are in generationally held family farms
Right.
where they're not interested in selling in the first place. And even if they were, it's just going to be so much more expensive that you're handicapping or crippling your ability to go in and drill quickly because you have to raise that much more capital.
Okay. All right. Yeah, that makes sense. And then, okay, so we've got exploratory, and that probably comes on a spectrum because if you're doing
Absolutely.
exploration in the Permian Basin, that's a lot different than exploration out in the middle of nowhere. So we're from Texas, and for years we lived in Austin, and it just seemed like so many of our friends were caught up in this boom bust cycle, especially before shale and vertical drilling was invented, shale extraction. I remember reading back, like probably about 20 years ago, an article on how we're going to hit peak oil, and eventually we have to come up with alternatives like solar and wind because um, humans have ingenuity, and we're not going to let us have no energy. But the rebuttal to that was we absolutely still have shale, but we don't want to be doing shale because it's like sandy and dirty, and it burns dirty. And so I remember always being very afraid of shale when I first started learning about it. But then all of these shale revolutions started happening, and I was just kind of floored about how much different the landscape looks from even say 20 years ago when I first started going down this rabbit hole in Texas when we lived there and thinking like, wow, shale is not just the dirty solution that we're going to be desperate to rely on. It's now kind of the savior of the industry. So I don't know if you can speak to anything about just the technology on. You said you don't know as much about the drilling side, but it just seems to me like these shale revolutions that we keep having these technological advances from some of the larger companies are really being able to have these smaller companies explore wells in a way that we've never been able to before that are actually going to be profitable.
100%. So I think the largest technological advancements that we've seen in oil and gas and drilling specifically are threefold. Number one is going to be fracking.
Mhm.
Number two would be horizontal drilling, which has really, really changed the way that they attack different types of formations. Because in, if you imagine that you're looking at the earth like a piece of cake that you can see from the profile side view,
Yeah.
and that formation is kind of running like not even perfect. Like there's ebbs and flows to where the oil or gas is actually trapped within that profile view. What we're trying to do with the horizontal well is stay in that zone as long as possible, sideways. And then you're fracking all of those different fissures, which allows that oil and gas to come through. And something really interesting about fracking is the reason that they use sand in addition to the water that kind of blasts open the actual shale formations is because the sand acts as a prop that keeps those tiny fissures and cracks open enough to allow the oil and gas to flow back through. Otherwise, the formation would just close back in and collapse under on itself. So, just something kind of crazy and cool about the process. But the final one is 3D and 4D seismic, which allows the geologist to almost have like an X ray or an MRI of the earth and get a variety of readings that give them levels of confidence as to not only the presence of oil and gas, but also the quantity of oil and gas within a targeted zone.
Okay. Oh, I don't know much about that. I know with the proppant that's coming out that pet coke that they're using to kind of cut the sand with that's bringing out an even higher percentage that you can extract from these from fracking, and that's been a really exciting to kind of watch that develop over the years. I don't know if we moved to Salt Lake City about 7 or 8 years ago.
Okay.
My daughter's a mechanical engineer, and she now works at one of the refineries here in Salt Lake City. So I feel like on the tech side, I still don't really know what I'm talking about, but I'm being more exposed to that than ever
Yeah.
before, even when we lived in Texas, because now we have, kind of somewhat at home designing these pipe systems. So it's been fascinating to kind of go down and learn about this from just a technology standpoint from her, but then also from an investing standpoint from the rest of my life. So I think these innovations are really exciting. Now, kind of give us a sense of now that I mean, there's a lot more to explore here, right? We could go on for hours about different asset classes in oil and gas, but you're giving us kind of an overview of what we can look at. What does King Operating specifically, what's your niche?
Our niche is large funds. So we want to take risk off the table while still maximizing potential upside. And instead of it being something that you're investing in that first year and going to hold on to for the next 20 years until the mailbox runs dry, is that we want to have an exit within 3 to 5 years. So we've tried to mirror this more closely to a multifamily approach rather than the traditional old school, very risky one well, well bore assignment, like I was mentioning earlier. So what we'll do is a mix of exploratory drilling in developmental areas. So to your point, more exploratory within proven areas, not necessarily just throwing a dart at a random spot in Texas where the land is cheap or the lease is cheap. And then we want to also include usually around 30 to 40% of non-operated investments as well. So working with companies like ConocoPhillips or Choya or Dominance or Ring Energy, a variety of other partners that are larger and are in the middle of a drilling program, they will allow us to provide capital because it helps them accelerate their drilling operations and their timeline versus them having to stage it out for whatever fiscal budget they're on for the year. So sometimes they will allow us to buy a portion of the wells that they're drilling right now, which is significantly less risk. And it helps expedient or it helps to accelerate the ability for us to start making distributions to investors early on. So if we start raising money and we're going to raise $125 million, some of the first dollars in are immediately going to typically go towards one of those types of non-operator investments so that we can get distributions started as quickly as we can.
Okay, interesting. So, this is just I don't know, I don't know what any of this even is. So I'm trying to relate it to something that I understand a little bit more. Like we call maybe a feeder fund. So, for example, there's a larger company that's maybe doing some sort of investing, and we want to provide capital to that larger fund. So we may start a small fund that we're going to feed into the larger fund, and then as long as we can get them a better deal, I guess that's kind of what we do on the equity side of what we do. We mostly do hard money lending. Like we're lending it out to rehabbers, flippers, hard money loans. It's pretty direct relationship to our borrowers, but we also do a little bit of equity where we may ask our investors, do you want to go into this investment? If we can get you a better deal in this investment than you can get by going them to them directly, because they're going to give us basically a volume discount. Does that have anything to do with what you're talking about? Am I going down the right road with this?
Not particularly there, just in that feeder fund example. So we actually work with feeder funds that come to us and bring capital, and we'll give them a preferred split because they're bringing one check. It's easier for us. Investor relations likes it. Accounting likes it. All the efficiencies that come with the fund to fund model.
Okay.
But a good real estate example is, let's just say that you were raising $100 million real estate fund and you wanted to put 70% of that capital into new developments that you're building.
Mm,
Obviously, those are going to take a while to start creating
yes.
income because you got to develop, you got to go
Sure.
to the city, blah, blah, blah. But the other 30%, you've identified some partners that you have due to your position in the market that are close to being done with their buildings, but they're short or they're going to be delayed if you didn't bring in some amount of money. And they allow you to buy into this building that's 70, 80% done already
Okay.
or already in process or whatever the case may be. And now all of a sudden your investors start benefiting from the rent coming from that building or those buildings, bless you, that are almost done. Um, and they're still participating in the upside of the buildings with the 70% of the capital that you're developing. And so it's just really this hybrid model that tries to take some of the risk off the table, get investors some cash back as quickly as we can and get those distributions started, and then still have that 3 to 5 year target for the exit window as well. And
Okay.
that's really the difference.
That makes a lot more sense because we will do that in a development fund where if it's a multi-asset fund, we may say we're going to purchase an existing product, maybe two or three existing products so that we can get cash flow going. And then we're going to buy into things that are pre-certificate of occupancy or buy them straight from the developer after they've loaded them. There are all sorts of stages. That's what I like about development is I feel like there are so many exits along the way before you have a stabilized performing project. And then you run it for a few years and then it gets dilapidated and then somebody has to come in and do value add. Do you have wells like that that need to be recovered that have been neglected for a while? The technology maybe is out of date.
Some of those fields that have dilapidated wells or just have vertical wells back from the 70s or 80s, the geologists kind of eat that stuff up because they're like, hey, there's some evidence that there's good oil and gas here. Now we just go in with new technology, specifically fracking and vertical or horizontal wells, and then we can really capitalize on that. Now that's going to be one of those ones that's a little bit more expensive because there is some of that proof and some of the risk is taken off the table. But to your specific question, there's also wells that aren't maybe just dead all the way, but are just producing 20, 30 barrels a day where you can go in and do something known as a workover, which
Hmm.
that gets way beyond what you and I will be able to have any meaningful conversation of what they actually go in and do. But think of it like cleaning something up, making sure the pumps are working efficiently, maybe refracking some of it to try to open up those cracks better, use new prop sand to try to create a bigger opening for it to flow through, all of the different little technical things that the geologists and operators can do to go in and revitalize those wells. Now, that may only be a $2 million expense that could increase the production of that well from 20 to 30 barrels a day to 200 barrels a day.
Hmm.
And there are operators and oil and gas investors out there that specifically target workovers and like well revitalization.
Okay. Well, I think it's important to understand the technology or the product that we're going into because if we don't really understand what's going on, then we can be victim to people who are maybe doing things that they shouldn't, or they get away with a lot. Maybe it started out legitimate, but then it starts going off the rails. But we have no idea because we don't know what we're talking about. So I do think that the technology is an important part of it. But I think what draws most people to oil and gas is not nerding out on the science. It is high returns or great tax benefits. And so with oil and gas, just like with real estate, the government wants us to provide housing. And so they're going to give us really good incentives to do that. So they don't have to have public housing, but also because we're paying a lot of other taxes. So we may not be paying capital gains and what's the other one? Income taxes.
Income tax.
We really get out of, but then we're paying, like I said, property taxes, payroll taxes, sales tax, because all the stuff that we're buying. So we're paying a lot of taxes. It's mostly like a shifted onto the business versus onto the individual. And so a lot of times with oil and gas, we see those graphs like energy consumption tracks 1 to 1 with GDP. It's incredible to kind of watch these graphs. And so you know we're highly incentivized to produce more energy, even if the government is taking a little bit of a loss on it. I don't know if this is true
Mhm.
from a tax standpoint because it's so important for the growth of the economy in general. So give me some indications of what kind of tax benefits we can expect from oil and gas. What are the ones that maybe that different kinds of people are looking for different kinds of tax incentives and why they're there in the first place. Because if people understand why these tax cuts are there, I think they're often very misunderstood. Oh, we're just giving tax cuts to rich people is a common misnomer. But just understanding like the role that this product plays in the economy is important enough to give it great tax incentives. Kind of walk me through what that looks like.
Yeah. So I think one thing a lot of people don't realize is all of the uses that oil and gas have outside of just specifically energy or at the pump or heating elements. It's in plastics, it's in lipstick, it's in so many of the things that we use on a daily basis. So that's part of the overall reasoning for tax advantages or tax incentives. But also, you're correct. If the world is growing, if GDP is increasing, if we're going to continue to invest in supercomputing and AI and the cloud infrastructure. I actually saw a quote that was like, the cloud right now uses more energy than the entire world used in like the early 1900s. So all of these technological advances, crypto that just drain energy and power are going to need more, just more robust power networks. And I think if you were still here when the grid went out in Texas and people were like freezing to death because it happened in January, just in their homes, yeah, I mean, snow apocalypse, yeah. Um, so I think that's a good reason enough. But the true backing of this tax incentive, IDC's intangible drilling costs are the specific nomenclature that it's referred to. And so it's not depreciation, it's not a depletion allowance, it's not these things that we're more familiar with from real estate. It is IDCs. And it goes back really for the biggest thing and increase of the tax incentive to the Reagan era.
Mhm.
And what Reagan wanted to do is he wanted to take the United States from being a country that was completely reliant on international importing of oil and gas and all of our energy and make us more energy independent. And so the IRS worked in tandem with the Reagan administration to say, okay, how do we make this more attractive? And the tax advantage is how we ended up. Now,
Right.
to the question of how much can you expect, that is heavily dependent on the operator that you're working with because not everyone can allocate or achieve the same level of IDC deduction for the first year, which is where you get the majority of that advantage. So no matter who you're working with, you do want to look into the track record of the tax side of it as well. So it's not just like a flat across the industry. It is heavily dependent on how they're allocating those funds, how they're spending them, how much is actually going below the surface of the earth, because those are the only expenses that create the tax incentive. So it has to be anything below the surface.
Well,
Um,
how do the tangible drilling costs affect the tax incentives? I
as, Not an expert on the tax, or I don't claim to be a tax expert by any means, but as far as I'm concerned, the tangible drilling costs do not have a significant impact. It is really in the intangible drilling.
Okay, so that's where the sweet spot is and understanding what
Yes.
you're looking at. Now, another thing that I heard, I was at a conference, I guess it was about a year ago, and I was talking to one of the oil and gas presenters. It was basically a conference for large funds to talk to potential investors. And they were talking about the LPGP structure. So the limited partner structure, those tax benefits do not pass through. But if you're on the general partner side for like a year, and so you have to get a new one every year, and as you're raising capital from accredited investors, I think it's important for them to understand exactly what's going. So you might know a little bit more about that than I do because it's an important part of the way that it's structured. And I didn't really understand it when he was explaining it to me well enough to remember it for a year. So can you go over that a little bit? Just refresh my memory and also maybe my listeners who are like, I've never heard this.
Totally. So at King, we actually acquire a third party tax opinion that essentially states when an investor comes in the first year, they're subscribing as a general partner. That's what allows them to get access to the active income deduction on their tax return on the K1s that we send out next year. The switch to LP occurs automatically on January 1 of the year after your capital contribution has been made. So I've had people that invested December 31st that were a GP for literally a number of hours and
Yeah.
then converted for the next year, and they still get the entire benefit of the tax as they would if they had invested in January 2nd in 2025, and then they had to be a GP the entire year. So yeah,
Is
I
there
mean,
is there a different return uh, benefit to being a GP versus an LP? Because or do people just keep re-upping as GPs as they get more money each year so that they can get that tax benefit? But what's the benefit of just staying on the LP side? If you're losing those tax benefits, would that be more for someone who's looking for cash flow on a performing project? Or I mean, break
that
it
could be someone, yeah, that could be someone that has a ton of passive income that they're trying to offset and they have already zeroed out their active or they're retired and they don't have any, they're not having to take any required minimum distributions from a retirement account. Whatever their situation may be, we've had people that want to come in as an LP
Mhm.
and just offset passive. Obviously, on a tax perspective, they're getting less bang for their buck than you would if you're offsetting income at the 40 or 50% marginal tax bracket, just depending on where you are in your financials. But that's also the case for the people that come in through a qualified self-directed IRA,
Yep.
and they're not getting any tax benefit whatsoever. They're just diversifying their portfolio and doing this as part of their retirement investments.
Correct. And I think that's an important distinction to make because the tax benefits that come with real estate or come with oil and gas, the intangible costs, those are not realized inside of an IRA because the IRA is already tax advantaged account. It would be like double double tax savings. So coming in with an IRA as for people who that's the money that they have, they're just looking to grow their portfolio or just diversify. So that's somebody coming into it with no tax incentive at all, other than the fact that they're investing in the IRA. And I think that gets lost a lot of times because we're talking about
Mhm.
mentioned a lot, or these drilling costs that come off of our active income, all of these great things. But you kind of have to pick a lane.
Totally.
Yeah. And
You
for me,
do.
the lane is because as a real estate professional, which I'll probably be for many more decades to come, uh, the tax incentives for me are not that important. But I think it's important for me to understand because I have investors who ask me these questions. I'm not a financial planner, but at the same time, I could say, hey, you might want to ask your financial planner these questions, or let me introduce you to some people who might be able to educate you on this because, like, I don't provide that for my investors.
Yeah.
Yeah.
And you don't want to from a liability standpoint. So
Yeah. Well, yeah. Call me disclaimer. There we go on the show. I am not a
yes.
financial advisor. This is for educational purposes only. And in no way does somebody coming on the show and hint or insinuate that I am a proponent of that investment. I am here just like you, the listener, listening in to educate myself on these kinds of topics because I think it's really, really important that we learn to do our due diligence. And that's the next section that we're going to talk about is the risk management and the risk profile. This is why due diligence is so important and understanding the returns profile and also the tax profile and how that interplays with the risk profile will help you to ask better questions that are better suited for your specific financial situation. Because as we talked about at the beginning of the show, as a real estate professional, my tax ID or my tax way of paying less in income and capital gain taxes, it might be completely different than yours because maybe you and your spouse or partner are both W-2 employees and you have a very different tax outlook. So understanding where you're coming from, what the options are, and then being able to ask the right questions is so, so important. So, Cole, with that, let's get into a little bit of the risk profile. We kind of talked about it at the beginning with the technology side of things, like how to choose something that is maybe more or less risky based on our goals. But can you just give us anything that we didn't talk about there that is important for an investor to understand about investing in oil and gas in general, and also specifically in King operating?
Sure. I think when you're looking at oil and gas investments and you are approaching it with the mindset of you're going to take advantage of the tax savings, that typically, so at King, we average around 75 to 80% as a year one deduction factor. So $100,000 investment is going to create a 75 to $80,000 loss that you're going to be able to offset active income with. Ideally, if you're in a 40 to 50% tax bracket, that's going to save you $33,000. So I look at that as, okay, I was able to take off 30% of my risk day one as a more guaranteed element of the investment. From there, now the way that I would evaluate any oil and gas investment is, am I investing in true exploration? Am I investing in developmental? Am I investing in a blend like what King does with kind of that blended approach of the fund? Also, am I the first dollar in or have they already started deploying capital? How many wells have already been drilled? Are they already making distributions? What's the track record of the company? How long have they been around? Who is the geologist? How long have they been around? Have they drilled in the areas that they're targeting and drilling in currently? What are the nearby comps of other companies? Who's drilling nearby? What are their wells producing? All of that for Texas, for example, is public domain on the Texas Railroad Exchange Commission. So there are public state ran sites where you can actually go do research on what wells are producing, who's drilling where. Does the company that said they own a lease and are drilling actually have the permits associated with them on the Texas Railroad Exchange Commission website? So there's so many little things where you can at least just do a quick BS meter and check, okay, is this above board? And then from that point, it's like, maybe they just suck at operating, or maybe it works out and they're fantastic, or maybe just the geology with that, or maybe there's all of those little volatility and variables that you have to pay attention to. But I would say in general, from a due diligence perspective and a risk perspective and profile, oil and gas investing is not for the faint of heart. It is something that's a lot more volatile. You are investing in something that, unlike real estate, has a commodity, two different ones that are moving every single second of every single day.
Mhm.
That's completely out of the control of any operator's hands. And then you're investing in something that is extremely sensitive to geopolitical happenings, whether that's war, whether that's negotiations, whether that's the Saudis, whether that's Russia. All of these different elements come into play. And there's just so many things that can move the price up and down. And so you want to know break even prices, just in case, what is your downside? And I'd say those are like the top 20 questions that come to my mind when I'm looking at this stuff, or the questions that get asked of me by investors or even some of the geologist investors that we've had that really want to dive into the nitty gritty because they know, because they've worked in the industry, or even just stuff that my dad's asked me about what we do. That's, I've kind of picked up on over the years. So that's really the core stuff is like track record. Where are you drilling? Do you actually have the permits? Do you actually have the lease? What is the insurance policy that you require of your contractors? What is the insurance policy that you're required to carry as an umbrella? And then from there, there's just all of the different little variables for any given instance or lease that you're looking at.
Yeah, and then let's talk about just investment risk in general, because I feel like when I'm reading about any kind of new investment, you're on Reddit trying to get like people's opinions of a certain company, a certain operator, a certain asset class. I see again and again and again people saying things like, you're not guaranteed to blank. And I feel like, is this common knowledge that when you're investing that there's no guarantee and that's the purpose of diversification? How do you manage expectations of investors early on so that they understand that there's no such thing as a sure thing, but that we're going to stack our deck in a diversified way in order to create a complete portfolio? What kind of education are you giving to your investors?
I firmly believe in the overpromise, underdeliver, or underpromise, overdeliver mentality of that. When you look at oil and gas, number one, price is completely out of our control. Number two, regardless of how much geology and operation excellence we may have, drilling down in the earth 10,000 feet off of, you know, nearby comps, geology readings, mud logs, electric logs, and just experience, you still never know what you're going to get. You can have poisonous gas that can offset the program for 10 months. You can have hard rock that wasn't foreseen that is eating through drill bits and it exceedingly causing the cost of that well to go way out of proportion to what we originally expected. So I just try to tell these people like, yes, our goal is to deliver X range of passive income on an annualized basis, but don't earmark this money for your mortgage or your bills. This
Okay.
should be bonus money. The long term value of a king fund is really in the exit because that's where most of the upside is. And that's what differentiates us from some of the other players in the oil and gas space is because we're giving our investors that pro rata share of the lease itself, which is that underlying asset. When we drill a well that produces, the SEC and the oil and gas industry at large allow us to say that there is a proven undeveloped well on each side of that well that should produce a similar amount of oil and gas. And that's the value add that each well that we drill successfully in a field that continues to increase that potential exit value. And so, one of the common questions is like, what happens if oil goes down to $40? I'm like, depends. Is that at the time of exit or is that just during the hold period? Because if it's during the hold period, yes, that sucks because distributions are going to suffer. But as long as it's back up into 60, 70, $80 range at time of exit, you're going to love us and you're going to be very, very happy with that at the end of the day. But then also matters on volume of production. Are we hitting the targets that we wanted there? And that could be higher or lower and meaningfully impact returns. So it is one of those things where you just got to be able to strap in, understand that it's a riskier investment on paper from day one than real estate or something else like it. I mean, and obviously you can get yourself into a very risky real estate investment, but on paper, when comparing it to a hard asset like a hotel or an apartment complex, it's riskier.
Yeah, definitely. And I'm the kind of person who's looking at like an S&P 500 index fund that's totally passive. I literally put money in. There's nothing I can do. There's no operator to talk to, no questions. It's a public opportunity. That's what my benchmark always is. Like, how much more difficult is it to investigate, learn about, and manage than just a straight up, index fund? We have a lot of statistics behind versus how risky it is, what it's likely to return, all of that. So I'm always kind of in my head, I'm not really a stock investor. That's why I just like index funds, but I'm always kind of benchmarking what we do against easy opportunities that return consistently well. Can we beat that? It's never going to be easier than that. I mean, any kind of private investment you're going to do is going to take more time than a public investment. I mean, the teenagers are allowed to put money in public markets, right? And so I feel like, okay, we're going to start to invest a little bit more time into this. We're going to take a little bit more risk on with this because it is not publicly offered with the same kinds of regulations and asset tests and all that. And so just the going into it understanding that I'm carrying more risk here because maybe I don't know what I'm talking about in order to be able to pick a great company. And how much time do I want to spend? Like for me, I've got podcasts. I can say like, "Hey, Cole, come on and educate me." We could talk to lots of other um, operators and ask them all of these questions. And so I'm kind of doing this due diligence right now in real time, so that the listener could be like, "Hey, what's their need to know?" So we just got a quick overview. A 40-minute conversation is not going to make somebody say, "Oh, take $1 million of mine and use it." Right, but these are the places to start. So you gave us a really good, um, resource with the Texas and Railroad Exchange Commission, which I would actually never heard of. So tell me, a couple of things maybe that just as we're wrapping up, what else have we not talked about that you wish that you could tell every investor who comes through the door asking, "Should I invest with King?" And then let people know how to get a hold of you as well.
Totally. I think one thing that you mentioned about the S&P and just an index fund that is super, super safe and super passive. When I am comparing this or other types of investments to that are also passive, like obviously the people that come into our funds are not going to the field, they're not giving us insights or anything like that. It's still just a hands-off investment. Check your email, check your bank account. But when you look at the tax savings, obviously there's a time value impact to that. If it truly ends up being for you 30, 35% year one, crushed. That's way ahead of the S&P because you'd be lucky if that's your 3-year total return over that same span. From there, if our funds average anywhere from 10 to 15% annualized monthly distributions, obviously that's beating it as well. And then if it ends up being a 2 to 3x at time of exit within a 3 to 5 year period, again, you're crushing, you're definitely being that, and it's worth your time and energy going in. The biggest thing I can tell you is read the PPMs, read the investment deck, check out the fees associated with it, check out the strategy, check out the track record. And I think number one, you're going to educate yourself a lot in that PPM because if you don't understand something, now you're going to have questions to ask. And then number two, when you're going through that, you're going to either see how thorough it is or how many gaps or holes that you're able to kind of identify just as like a novice coming into it. So I think that's the most valuable thing when you're doing your due diligence in any investment, but especially something that's so technologically heavy like oil and gas. And then as far as getting in touch, like she said, my name is Cole Oliver. I'm an SVP at King Operating. We have a headquarters here in Addison, Texas, just a little bit north of Dallas proper. Um, I'm assuming that you'll be able to share my contact information in the description or something like that. So
Definitely. Contact information in the show notes or the description. And also reach out to me if there's ever been anybody on the show that you want to get in touch with, because I can put you directly in touch with anybody that you would like to talk to. The reason we do these podcasts, and I say this almost every episode, is because we want you to reach out to us after the show. If you are considering investing, great. That's like our ideal listener, is somebody who actually does want to invest passively, either with Retoro's fund, with one of the funds or the investments that one of my guests is talking about. But just please reach out after the show. And if it's not quite right, it's not quite a good fit, both of us know people that we can introduce you to that you might go down that rabbit hole. Because I would say never invest with the first person or the first thing that you come across, especially in a new asset class. Do some due diligence and research several companies and spend a little bit of time with it. We talk a lot about taking action and not getting caught up with analysis paralysis, but there is a time and a place to get information. And there's a time and a place to say, like, I have 80-ish% of what I need to know. And now I just need to make a decision. And we are not saying just jump in, take action without doing proper due diligence. I feel like there's definitely something to learn about yourself, which side of that spectrum you lean more towards. If you're more careful, you're more analytical, more research based versus more like, hey, sure. I had a surgeon tell me one time, he's like, yeah, let's just put it all in. I can make more. And I'm like, well, okay, are you sure? Because what if your hands start shaking? He goes, I have a really good insurance policy. So that type of thing is on the other end of let's just try it out. So as a listener, just make sure that you are going your speed for your own style and that you're overcoming whether you're jumping in too fast, like the surgeon I mentioned, or it's taking you forever, just trying to come into the middle a little bit and being able to make a decision eventually once you've done some due diligence. All investments carry with them not just the risk of loss, but the risk of total loss of capital. So I always want to make sure that everybody understands that if a deal goes bad, it could have a total loss. I've had a few of those where I invested money and it was a total loss. Maybe the bank foreclosed on the property and us, the rest of the investors are like, there's just there's no property left, right? Like we were holding equity, but the bank had the bank basically owned it. So those are some hard lessons to learn, but at the same time, it's something that can change your life. It's changed our lives dramatically. Like we retired early, we travel full time with our family now. It's an incredibly different landscape when you really do commit to going down this path. So get a hold of me, investwithemma.com, if you would like to get onto my calendar. Let me know, LinkedIn, Emma Powell 28. Send me a DM if you just want to have a phone call. Just let me know, and we'll go from there. But we can definitely get you over that hump of getting into this world of private investing that you may not have experienced before, or into a new asset class that, especially if you listen to this podcast, you're probably real estate heavy. But I try to expose you to a lot of different types of things. So hopefully that is helpful information for you. And you can then use that to make your own portfolio stronger. So thank you so much, Cole, for coming on the show today.
Absolutely.
Yeah. And to all of you listening, I wish you the best passive income adventure of your choosing. That my life may not look like the way you want your life to look, but we all pay for it using the same color money. So I will see you again next week where we're going to hear about your next investing opportunity on passive income adventures. Until next time.